Well, overall, if it's a step back, it was, I think, a very strong performance for the bank. So year to date, our income is up 15%. We were up 15% last year as well. We made almost as much underlying profit in 9 months this year as we made in the whole of last year. So I think the overall performance of the bank is very strong. China specifically, we took an impairment charge against an investment in a business in China where the onshore activity has been lower than recently. But for us, what has been really interesting is the offshore activities. So Chinese clients operating outside of China, we have seen income almost 50% up year on year. So slightly flat within China, but very, very strong outside of China.
So how do you play that strategy? Because the mainland market has been very key for a lot of banks over the last decade or so. And I think the narrative has now shifted around doing business in China to an extent, thanks to that property bubble being burst now. So how do you think about maximising returns from the region?
Well, I think the thing to understand with Standard Chartered is we're not a domestic bank in China. We do not operate a big retail franchise. We are much more supporters of export and import activity for corporates and also renminbi dollar exchange. So what is happening at the moment actually is quite good for us, because a lot of the businesses there are looking to expand outside of China mainland, and that is essentially what we've spent, 160 years specialising in.
Yeah, you're the first derivative, aren't you, on that domestic market? Well,
yeah.
But in terms of, and just to kind of drum down a bit further on Karen's point as well, you will be affected by everything going on domestically. Of course, you've noted the commercial real estate issues as well. What do we think on China at the moment? I mean, because there is a beginning of a line being drawn in the sand by a lot of people. It's, OK, now we've had the downtick, we've had the less than exciting recovery, the commercial real estate problems, the concerns about what the government is doing, isn't doing. But I'm not convinced either way at the moment that I have a clue where China's going. Yeah. But you are far more the expert, so what do you think?
Well, what we are seeing is probably a slower recovery post-COVID than in some countries. But it's a huge population to mobilise after such a big event. A particular sector, commercial real estate, that clearly has been problematic. But the forecast of GDP growth for China over the next 2 to 3 years back up at around the 5% level, most countries would be more than happy to have that sort of growth level. So we are very, very much of the view this is a period that we need to go through. We'll stick with it as the economy gets going, then that should be good for us. It should be good for others.
They would, and if that's a real 4 to 5%, then there's obviously concerns about whether that's enough to avoid the middle income trap. But I don't want to go any more into it, because I want to do what you love most, which is going into the nitty-gritty of numbers. It's why you became a CFO, I'm sure, as well. Your ROTE at 7%, down 2% year on year. I see the higher tax charge as well. But when I look at different ROTEs across the sector, I see an enormous band of difference. UniCredit, dare I say it, came with an 18 handle the other day as well. Are you happy with your business mix at the moment that's producing a ROTE of mid to high single digits?
So the 7% is slightly low because of tax. And if you put that on one side, the tax will normalise over the course of the year. So we have reaffirmed today that 10% for the full year is what we're aiming to get to. You have to go back probably 10 years since the bank last printed 10%. So that is going to be progress. We have said next year 11%, and then we'll try to build it higher. So every bank is at different stages in the ROTE, but for us, the 10% is a very critical number. If we get there this year, when we get there this year, that will be a big milestone for us. Brilliant.
How much of this is down to the NIMs? And maybe you can unpack these numbers for us. What net interest income was up 20%, but there was a normalised net interest margin level here, 1.67%, transient reduction of 4 basis points. We know the narrative from some central banks is like we're almost done when it comes to interest rates now. And there's been some deposit competition, which we've seen through the lens of some high street banks across the world. What are the different moving factors now?
Well, despite the earlier comments, I'll try to keep this high level. But just over half of our income actually comes from fees, not from interest. Just under comes from interest, first point. The net interest margin is the interest piece of this, and clearly the difference between what we get on what we lend and what we pay for what we are borrowing. That has been increasing a lot over the last couple of years with rates increases. So the NIM is about 20% higher now than it was a year ago. It was a little soft in the third quarter, but we have said we expect the fourth quarter to be higher. And actually, for this year, if we end up at around 170 basis points, we are saying next year should be 175 basis points. So we are actually still on an increasing trend on the NIM. A lot of other banks are actually sort of, at the moment, probably at about the peak point, but we are saying that there is still further growth in our NIM in the 2024 year.